just as people believe that the inflation dragon has been slayed, it rose back strongly in 2025 because, and the basis for that is that the setup that we saw for high inflation, the environment in 2020-21 that drove inflation higher, a lot of those factors are really coming back over the course of this year and into next year. So if we look back, we saw this inflation spike in 2021, 2022, and that was something we hadn't seen in the developed markets in many years. Inflation had presumed to be dead. Even with the massive monetary stimulus post-financial crisis, it wasn't sufficient to get inflation back up again, and many presumed that inflation was effectively dead. However, the combination of factors in 2020 and 2021 did drive inflation in the developed markets to levels we hadn't seen in several decades. Now, what were those factors? Firstly, you saw supply constraints. That was brought on by COVID. This is an example of shipping prices from China to the US, logistics shut down, factories shut down. It was very difficult for goods to be produced, goods to be moved. And then as that eased, people, you saw people in lockdown, they were wanting to buy a lot of goods. And then as that eased, you saw people then wanting to consume services, go out to restaurants, travel. So you saw this prolonged inflation caused by these supply constraints. Second factor was monetary stimulus. This is a chart of the Fed's balance sheets. It shows the amount of money creation that happened. On the right-hand side, you can see that in 2020 and 2021, the Fed was increasing its balance sheets by trillions on a monthly basis. Even as it calmed down in the following years, those bars are still bars which are above $100 billion. So the amount of monetary stimulus we saw, money printing, exceeded that post the financial crisis on unprecedented level. So easy monetary policy, you combine that with the third factor of fiscal stimulus, checks being handed out. This is a chart of personal income in the US. That spike in 2021 was almost 30%. So we had this crazy environment where you had a recession on one hand, but incomes rising by 30%. And those factors, these three factors combined to create that spike in inflation, which it took a long time, which it took aggressive rate hikes to bring back under control. So it was only in 2022, when inflation was rising to 5, 6, 7% in the developed markets, that central banks around the world finally woke up and they realized that they needed to bring this back under control. And you saw aggressive rate hikes. We haven't seen these type of rate hikes from developed markets in several decades, but we saw that in 2022. It had a very negative impact on sentiments, on the markets, but eventually it did moderate inflation and cause it to bring it back somewhat under control. Not quite to the levels pre-COVID, but much closer to targets than where we had been in 2022. Now, heading into 2025, I think that there's a potential for the inflation shock to bite back strongly. And the reason for that is that the three factors I've outlined, which drove inflation higher in 2020 and 2021, are set to reappear. Not necessarily in the same way and to the same extent, but they all definitely are there lurking under the water. The first thing is the tariffs and the trade wars. The clash between China and the US is set to accelerate. And this is a chart of imports and exports coming out of China. And you can see that while imports have remained stable, exports in China have definitely increased, and their trade balance is at record highs. Ishrat outlined the dominance of renewables energy, the increasing dominance of electric vehicles, and the developed world, the US, the EU has introduced tariffs on electric vehicles coming out of China. Trump effectively, he calls tariffs the favorite word in the dictionary. And while we don't necessarily want to take him literally, we do think that he is going to increase the tensions with China and the deflation that China's been able to export for several decades now may be at an end. The second supply constraint has been labor. So under a Biden administration, you saw almost 10 million illegal immigrants crossing the border. And while that has caused a lot of social issues, it's been a big factor in moderating wage growth. You haven't necessarily seen the spike in wages that you would have expected at a record low unemployment growth. In fact, from 2019 to 2024, immigrants have taken 88% of the jobs increases in the US. So if you curtail that immigration or even start with deportation, you suddenly have supply constraints from a labor perspective, and we think that could be inflationary going into 2025. Secondly, monetary easing. So while we're not getting the quantitative easing that we saw in the COVID period, we are getting synchronized a rate-cutting cycle throughout the world. The STARB is set to meet on Thursday. We're likely to get another 25 basis points rate cut in South Africa, but across the world, we've seen rate cuts over the course of 2024, and that's likely to continue into 2025. So monetary easing is set to stimulate the economy and set to increase money supply in the system. And then finally, the fiscal stimulus that we are continuing to see coming out of the US, budget deficits. We recently had the medium-term budget in South Africa. We're still getting deficits of around 4 to 5%. We're still getting stimulus coming out of the US. This is the graph of the trailing 12-month deficit. You can see that while the US economy is growing, while unemployment is close to a record low, the US is still spending it still has printing a deficit close to $2 trillion. So the overspending habit that was developing during COVID, the developed world, the emerging world, they're finding it very difficult to let go. Ishrat talked about the fiscal stimulus coming out of China. It's a global phenomenon that budgets are just not being able to balance, and we're living in a state of perma-fiscal stimulus. So if you look at these three factors, going into 2025, loose fiscal policy, easing monetary policy, and supply issues, this time coming out of trade and labor, while they may not necessarily be to the same extent of 2020 and 2021, they definitely are powerful forces. They're definitely bubbling under the surface. And we do think that the market is very complacent in terms of inflation. If you look at break-even inflations that are being priced into the market, currently around 2% in the US, back to its historic levels. Inflation in South Africa priced in around the 4 to 4.5% level, definitely towards the midpoint and even below the midpoint of our inflation target. The market's very complacent of where inflation is likely to print, despite the fact that these pressures are building under the surface. So how do we deal with that? We do think inflation-linked bonds offer the best risk return at this point in time, giving you excellent real yields. In the US, real yields are around 2%, the highest in 2 decades. South Africa, real yields at around the 5% level. Even if inflation is normal, you're likely to get good returns exceeding cash. And if inflation does bubble back in 2025, you're going to get excellent returns out of this asset class. So I think for me, inflation reappearing is definitely something you want to position for, and the market is giving you a good asset class in inflation-linked bonds to take advantage of that.
Okay, thanks, Rashaad. Now, you drew some parallels with 2021, but one of the major differences that springs to mind for me is that back then we did see energy prices spiking, of course, because of the Russia-Ukraine war. And today, of course, as we mentioned in the intro, oil prices are actually falling. Now, one of the major drivers of inflation historically has been energy prices, and specifically the oil price. How does a backdrop of falling energy prices square with your view of inflation resurfacing?
That's a good point, Linda. So you did see oil hit $120 a barrel for several months in 2022 as the invasion took place and gas prices were limited going into Europe, etc. So there was almost this energy squeeze which happened, which caused energy to spike. But that was quite some time ago. So we're now in 2024, and since that peak in the middle of 2022, energy has moderated and is a big part of the disinflation that we have seen. So we're not close to 10% inflation in the developed world. It's more towards the 3 and a bit % level. And a big part of that driver is the moderation and the normalization in oil prices. However, that's in the rearview mirror. Oil prices are down towards the $70 a barrel. It's 40% down from its peak. Are they going to fall another 40%? Are we going to see $40 a barrel? I don't think with the cost pressures in the energy industry and the renewable industry, we're likely to see that repeated. And therefore, I think the disinflationary impact is actually in the rearview mirror.
Okay, now, Nick, I know you've had some thoughts on Rashaad's thesis. What would your question be to him to challenge his views on how things might play out?
Yeah, obviously I agree with a lot of his thesis, but we always think about the other side. And was it kind of a flat earth growth in the US that leaves the inflation where it is? And my question, I guess, is what happens if we have a global recession? What happens to inflation in that world?
Yeah, that's a good point, because it is something that we think about. We've seen a lot of spending globally. It's driven above trend growth. So what happens if that growth runs out? Because the economies could be running on fumes at the moment. So that is definitely a risk. And if you have a recession, you're unlikely to see inflation as basically demand falls off a cliff, which is what we saw, effectively at the beginning of 2020. If we look at the asset class that I'm recommending to protect you against inflation, I'm talking about inflation-linked bonds, where we're getting real yields of 5% in South Africa, 2% real yield in the US. That's very attractive relative to its long-term average of 0. In fact, when we see recessions in the US, you usually see that real yield plummet as monetary policy comes in to take effect. And in recessions, that real yield generally goes down to -2%. So if you look at the fall from 2% to -2%, that's a 400 basis points drop in real yields. And we know that bond prices are inversely correlated to yields. And if you see that 400 basis points drop, the price rise that you're going to see on the bonds and the performance you're going to see on inflation-linked bonds is going to be excellent, despite the fact that you're not going to get the inflation carry aspect. The real yield aspect is going to be the big driver of return. So we're quite comfortable with the fact that inflation-linked bonds are likely to deliver you good returns in a rising inflation environment, while in a falling inflation environment, in a recessionary environment, the falling real yields will actually enable you to get good returns as well.